Good afternoon. Thank you for joining us today. My name is Carole Laible. I'm the CEO at Domini Impact Investments. Just to run through some housekeeping, we're going to spend most of our time today in a conversation with Amy Domini. We'll save some time at the end, the final stretch, for some Q&A. Please feel free to submit your questions using the Q&A box at the bottom of your screen. We'll be reviewing those and getting to as many of those as possible. On June 3rd, in 1991, 35 years ago this month, Amy Domini launched the Domini Impact Equity Fund. To celebrate this, earlier this month, Domini Impact Investments established National Impact Investing Day to be observed every June 3rd. An annual moment to step back, ask a simple question. Are our investments actually building the future that we want to support? Recent research from Domini tells us that nearly 8 in 10 investors want their money to support a more sustainable world, but many of them aren't sure where to begin. National Impact Investing Day is a great way to fill that gap. It's a day to reflect, for education, and for those who are ready to take action. There's no better person to mark this moment than the person who helped start it all. She's a pioneer in the field. Amy Domini is our founder and our chair at Domini, and one of the people that's really responsible for the field that we now call impact investing. Her career began more than 40 years ago when she understood that people wanted their investments to reflect their values. In the years since, Amy and Domini Impact Investments have been responsible for a long list of firsts in this field. The first comprehensive book, the first index, the first mutual fund to publish its proxy voting guidelines, the first to publicly disclose its proxy voting record, and a founding signatory of the UN Principles for Responsible Investment. Amy is widely recognized as one of the industry's leading voices. In 2000, she was named to the Barron's All-Century Team, the 25 most influential people of the century on mutual fund trends. She was on that list alongside of Peter Lynch, Bill Gross, and Charles Schwab. In 2005, she was named to the Time 100, Time magazine's list of the world's most influential people. In that year, she was named alongside of Nelson Mandela, Steve Jobs, and the Dalai Lama. In 2008, she was named to the Directorship 100, the list of the most influential people on corporate governance and in the boardroom. She was named alongside of Warren Buffett, Carl Icahn, and Jim Cramer. Last year, Amy was awarded the Interfaith Center on Corporate Responsibility 2025 Legacy Award, given in honor to the select few whose work has provided a strong moral foundation and an enduring record of demonstrated influence on corporate policies. She's an author, a portfolio manager, and a community activist. She's shaped the way many think about investing, both individual investors and the largest global financial institutions. Amy, welcome. It's so good to have you with us here today.
Thank you very much, Carole, for that fun introduction. I didn't recognize myself.
It's been quite a list, well deserved. But as we reflect back, and The fund launched in 1991, but the work really began before then, almost a decade earlier. Take us back. What were you doing in the early 80s? And what were your clients telling you that nobody else on Wall Street seemed to be listening to?
Well, it was extraordinary. I won't go through the rather interesting path to it, but I did find myself in a job which then bore the title of stockbroker. One could compare it to the financial advisor of today, except that at the time, mutual funds were very unlikely candidates. People were actually picking stocks to buy. And so my job was to determine that I felt the stock was a great investment, and then to call people who had indicated they'd like to hear that information from me and discuss this investment opportunity. I learned very quickly that I had to be careful when making recommendations. People would say to me, my father died of tobacco. I don't want to be invested in anything like that. Or, I'm sorry, I lost a brother in Vietnam. I do not want to be invested in the weapons industry. And it's difficult to get somebody to the point where they're willing to take your phone call, and then to give them information they don't want was shocking. So I set about trying to figure out how I could learn more about this. And one idea I had was I would start asking my clients in the intake when they got to know me, and it's a process one has to go through. It's regulatory. You do need to know the client before you can make investments. I started inserting, is there an area that makes you uncomfortable in investing? Is there something you don't want? And I was astonished. I mean, the bird watcher didn't want to be involved in paper forest companies that were deforesting using chemicals. So I started to find what information I could, and was shocked at how little there was. And that got me feeling that somehow a ball had been dropped. The world was very interested in this. My investors were telling me this routinely, and I better do some research. I began teaching a course at Cambridge Adult Ed. I named it Ethical Investing. In the process of writing a course design and applying for the chance to teach the class, I wrote a book proposal for that. And I hoped that, I'd build up a little momentum and I could submit this book proposal. But what happened was the catalog was published, the class filled up immediately, and I got a phone call from a publisher. Will you write a book? I said, I happen to have a proposal to write a book already. I'll get it to you right away. And we got started. I think it's important to remember this was a very interesting time in American history. Uh, we're talking 1975, I began in that role as a stockbroker, and by 1980, I had a idea that this was the field I was going to be working in. So we had South Africa going on. We had just gone through the war in Vietnam. It had been settled, and we had discovered Agent Orange, and we had discovered the uh, terrible things going on in Cambodia as a result of the involvement in Vietnam. It was just after the 60s and all of that urban unrest and all of that reckoning and racial consideration had come to pass, and we were beginning to um, try to take steps toward reallocating money into communities that had suffered from discrimination in the past. The OPEC oil embargo had taken place, and all of Europe was flipping a switch. None of them were going to run off of oil anymore in their towns and municipalities. And Ronald Reagan had started to take steps to dismantle the social safety net. And community development groups were up in arms. They predicted that we would start to see homeless in the streets. So when I was writing the book, it was within that context of all of those trends going on. And they all came together in an argument that the way you invest matters. the investments we make today will build the society that we live in tomorrow. And we need to be deliberate about those things. I think I'll cut it off there, but that was a very exciting period of my life.
Certainly, you didn't rest there. So, the book was remarkable. It was quite an accomplishment, got those really thoughts brewing across the industry, but that wasn't enough, right? In the late 80s, you then set out to create the world's first socially responsible index, the Domini 400 social index.
Yeah.
Why an index? And what were you setting out to prove?
Yeah, it was a kind of a leap there. The book had meant that I was considered an expert instantly. It was the first, as you said in your setup remark, comprehensive book on this topic. The debate over whether or not endowments ought to divest from American corporations doing business in South Africa meant that every endowment in America, the local library, your school board, whatever, wanted somebody to come in and talk to them about whether or not they should divest from South Africa. And I had just written the book. So I was invited in to defend the concept in setting after setting after setting. And throughout that, I found that there were three major complaints that I perceived to be barriers to the message I was so interested in spreading. And the first of these was a presumption that anything that limits your investment universe would limit your return, which seemed crazy. I don't know a single investment advisor who doesn't promise that their way of limiting your investments is the one right way to enhance returns. But it was a very strong objection, and it led right to the argument that it would be illegal to allow these kinds of considerations into the investment decision-making process. And then there was the objection that who says potato and who says potato? Who are you to say that an Apple computer in the Department of Defense is enough or not enough to prevent a portfolio manager from investing in Apple? And and that was based on a perception that there were no standards out there. But if you looked at uh, international commitments to order in the United Nations or in the European Union, you would find that there were several standards too. We already had in faith-based groups for centuries, but at least for decades, the avoidance of alcohol, tobacco, depending on the faith group, gambling, military weapons. We already had 5 or 6 newsletters that had begun to sprung up, not on the exact issue, but on the issue of social responsibility and the decisions we make. We had enough standards. And I felt very comfortable in being the person to draw the line on what those standards were. And then the third piece that was out there, and I think has over time turned out to be the hardest, was it's the wrong way to do it. That's what charity's for. Make all your money and then use charity or something, which seemed like an extraordinary statement. Once you've mucked it up, go clean it. Or
Mhm.
I mean,
Yeah,
if
you're
you
at net zero. Yeah.
yeah. And I started to remind audiences that once there's a monetary reward for poor behavior, it's a lot harder to get rid of the poor behavior. It's much easier to get rid of the poor behavior before there's a monetary incentive to getting it going. So an index seemed to answer these three questions. And lo and behold, over the 20 years that the Domini 400 social index was tracking itself, it did outperform the Standard and Poor's and other broad market indexes. And it was very interesting because although And if you looked at month by month, it was about equal number of months that it was above and below. But when it was above, it was more above. And when it was below, it was less below. And I put a good deal of thought into that. And I said, well, actually, what are you doing when you have two companies and you say, well, this one has 4 product safety recalls, that one doesn't. This one has a kind of a low level retirement system. This one has a strong one. This one has a board that seems to be, drawn from uh, the same college that the CEO went to. This one seems much more independent and knowledgeable about the industry. Over time, what you're getting at is which company's more on the ball, which has a better management team. And so the bias that it gave in our 20 years of being the Domini 400 seemed to me to be a reflection on the quality of management. And that's when I really felt there's a there. The quality of management is being identified through quantitative means, the assessment of social and environmental research. I was probably late in the game, but I did come to the realization eventually.
Well, we often say, maybe non-traditional data that's being used, but certainly helpful. So, most investors that have access to more data that they think can help them build better portfolios will use it. And it certainly sounds like that's exactly what you were doing, using this data, helping to pick better managed, more forward-looking companies that would be well positioned for the future.
Mhm.
And as the field was building, I've often, there's a lot of discussion of, what is it? It seems really hard to learn. I don't know how to get my head around it. And you came up with this really straightforward analogy of a three-legged stool. Describe that for us today. I think it's a great takeaway for people who are really interested in the field.
It, you're right. People were kind of confused where it was perceived to be a fuzzy field to those on the outside. And those of us within it had come together. And thank you for the credit of saying I came up with. I always feel as though the early crowd that came together was an extraordinary group of people because it involved community activists and shareholder activists. And to have those two entities in the room with portfolio managers was an extraordinarily uh, useful and guiding light for all that followed. But to my way of thinking, the three-legged stool has come to represent what it is, the big it. What is it that we do as a mutual fund and as a field, as what do our peers do in the field, and that is to apply social and ethical environmental criteria to the investment decision-making process. I'll get to why in a minute. The second thing is to engage as an investor with corporate management teams in order to learn more about what they perceive they are doing on the issues that we identify as their potential weak spots, not necessarily because of the behavior they have displayed, but because of the industry they're in. If you are in the industry of mining, you automatically are drawing things out of the ground. This might be an environmental risk. What are you doing about it? And in the third area, support for community development, loan funds, not-for-profits, and for-profit entities that make a difference in the lives of people. I often say, for whom the miracle of capitalism has not yet worked, and that we can do something for them. So in these three areas, applying standards to the investment decision-making process, we have robust standards, industry-specific standards, key performance indicators that help us answer the question of what the company is doing to address their risk factors based on their industry. And sometimes something comes up that we can't handle that. We don't have the information, or we don't have a robust standard across all of the companies to compare one company to another, and we must engage directly with them. And, for me, the example that was so interesting was when we moved from an area where, we were all able to start buying things at these great big stores that were national in nature, and that drove prices lower and lower. And lo and behold, it turned out maybe they were being made in a country that had very different standards for what the workplace was, and what the safety of the worker was, and how much they were paid, and under what conditions. And we had no means of knowing what companies performed in a best practices way. We had to begin with dialogue. And that dialogue led to standards, and the standards led to review of the standards by third party outside, and then it led to on-site reviews. And then as time went on, we began to move beyond the standards to how the workers actually get in the door. Are they paying a fee? Do they give up their papers? But through the course of 20 years, what has evolved is a support for setting the standards and applying those standards to the investment decision-making process. Our bond fund is specifically geared towards support for community needed institutions and building blocks. And in that bond fund, we are able to make loans to nonprofit entities that are in the business of building for example, hospital or public playground, or something that will make life better immediately to the community at risk that they are operating next door to. And with these three tools, and it's not just Domini, it's the standard for the industry.
Mhm.
If you are looking for a mutual fund in this industry, look for this approach. And the peers within the industry will do these three things.
And I like to think of that three-legged stool as, those standards being, we think about it as being better investors, and that dialogue and engagement with companies as being better owners. And then that community investing as being better neighbors. So whenever, you're approaching a sustainable investing product, it makes sense to be asking yourself, what tools are they putting to work on being better investors, better owners, and better neighbors? So I think it's a great analogy. It really helps to demystify the field and what somebody should be looking for as they're evaluating product. So, taking a moment and thinking, boy, we've come far. We've come a long way. There's been incredible progress. This has been your mission and really your life's work. So tell us about some of those things that you find the most gratifying or the most tangible progress that you see, right? Because often it's, what difference does it make? But we see it. So share with us what you find the most rewarding.
Well, again, thank you for that question. This is really the nub, I think, of this field is, okay, is this feel good, or is this actually accomplishing something? And I have collected a few talking points on that issue.
We all love factoids.
Yeah,
Bring them on.
In the first thing I want, before I go to specific talking points, I just want to remind people that there is a whole, we don't care much about philosophy today for the first time in 2000 years. People don't study philosophy and move into philosophy, but there is a whole philosophy that goes back centuries, that things you acquire, things that you surround yourself with, shape you rather than the other way around. And one important thing that is very hard to discern is how much empowerment you feel as a responsible investor. How do you respond to things differently? If you pick up a Domini Impact report and you read about it, and in that impact report, you become somewhat more interested in Uzbekistan and their cotton production than you were last week, perhaps you'll read the newspaper differently, or your scroll, whatever you get your news from, differently. Perhaps you'll maybe start looking into child labor issues. Perhaps you will begin to feel personally like part of the answer. And when you begin to feel like part of the answer, perhaps you will take more steps in your life to be part of the answer. In terms of our shaping finance writ large, Wall Street traditions, couple of factoids. In 2024, 99% of the Standard & Poor 500, 94% of the Russell 1000 provided sustainability reports. Nirvana. There wasn't any sustainability reporting going on in 1990. I was on the phone and I'd ask my questions, and investor relations would say to me, let me get the treasurer for you.
Yeah. Yeah.
And I'd be there, I'd be explaining, and he'd say, well, you mean like those basketball courts we keep up and, you know, and, or you mean like that natural gas that we run our power off of, because Los Angeles sits on natural gas caverns and we can suck the gas, and I'd get all these, but it was a lesson for management to do that. So now the sustainability reports are pretty exciting to see. The European Union's Corporate Sustainability Reporting Directive began phasing in January of 2024. The ISSB's Global Sustainability Standard took effect that day. Jurisdictions representing half of global GDP have announced intent to adopt these things. I could go on, but I think maybe some of the more high point ones, 85% of executives say their organization have increased their sustainability investments year over year. 88% of CEOs say the case for sustainability is stronger than it was 5 years ago. And 56% of CEOs globally now have personal incentive based on sustainability standards. Now, sit back and ask yourself, how many of those things would have happened without us? How many of those things would have happened if there were not responsible investors asking these questions, stating it's important, making it an issue in a combined across the board way? None of that would have happened. So anybody who says that this kind of investing is only feel good and doesn't make a difference isn't looking at the impact it's had on the global investing field and on corporate behavior at large. And just on that last point, the global investing field, cumulative global issuance of green, social, sustainability, or sustainability linked transition bonds reached $7.25 trillion as of March 2026. 7.5
Remarkable. Yeah.
trillion. Inconceivable in 1990.
Yeah.
So I thank my investors. They've made a difference.
They sure have. It's really been incredible. It, you know, brings to life the adage that what gets measured gets managed. As
Mm,
investors, they're sending the message that bringing together people, planet, and profit can all be done. In fact, can help a corporation thrive, has really made a difference.
mm.
But now let's think, you know, Amy, we certainly know you're not one to stop with progress. So looking ahead, what are your hopes for impact investing for the next 35 years? And, what does success look like?
But, I don't even want to count. I'm going to guess 35 years I've worked, and you've worked very closely with Stephen Leidenberg, who had a long history in corporate accountability work before he and I teamed up together. And he always answers that question by saying the future will contain a world within which investors no longer have to define themselves as ethical or responsible or impact, but it'll just be called investing. I hope that he is right. It is certainly true that as we move toward the future, we've got challenges overwhelming us, but at least a great many of these conversations are taking place about actual money. And if we look at global GDP versus the flow of funds that transact every day on your currency exchanges, your option exchanges, your stock exchange, your bond, your private equity, your private debt, all of those exchanges, I haven't found a good number, but I'm pretty comfortable with saying it's about, oh, not about, it's over 100 to 1 dollars churning around in the universe for every time I buy a carton of milk. There's no way that finance isn't part of the solution. It is global. It has near perfect information. It is completely unrestrained in terms of the resources at its command, and it is bigger than global GDP. So for the survival of all that we hold dear in terms of our lives and the planet we occupy, we must use this tool. And Domini is proud to be one of the first movers in recognizing this and in spreading the word.
Harnessing the power of those investment dollars to help build the world that we all want to live in. Um, Really incredible, and definitely see that we're coming out. I think there's a logic and it's intuitive that typically what's good for people on the planet is good for business too. So we don't think they're at odds. We actually think they help to make us better investors. Uh, so I did promise some questions, and we thought we'd only take about 45 minutes of people's time today. So we've got some great questions coming in where we see them as they come in. So feel free to keep submitting, but um, we'll start with a couple. So, um, what's your advice for people who they listened to you, they're inspired, they sort of came to it today with an inclination of wanting to lean into sustainable investing? What's your advice for how they can get started?
You know, it is always easiest to begin with what you know. You probably already have a 401k or an IRA. You probably already have made some investments, maybe kind of blindly, maybe kind of the default option that the company you work for has down there on. Start looking at those things. And if you really want to dig in a little bit more, every company publishes how it invests. Why don't you see whether they have real teeth to the way they describe how they invest, or whether it's kind of loose language about how they invest. So I would start out looking at those kinds of things. But beyond that, I just, want to drive home the point that every step is an important step in this. Just even a first small commitment in the area. Um, this is the easiest bang for the buck that you will ever make. Because once you become that investor, you don't need to go out there. Yeah, we appreciate it if you do, but you don't need to go out there and march on the streets to know that you have done something to launch these other actions going on, because we will do it for you. We will be involved in these actions. So, and I speak we writ large, the industry will do these things for you. Um, I'll cut off there.
Okay. I'm scrolling through some questions. So I think I'll focus on this one. How does Domini think about the difference between sort of exclusionary and best in class screening? So, are there industries where Domini draws the line, um, or does it depend more on a company's practices?
Um, Thank you. That's a provocative question and has been for 30 years. Um, and and it really traces all the way back to the formation of the index. And as that index was being created, we did base it on what the investor who applied ethical or social criteria to the investment process that existed, what were they doing? And that brought us to understand that there was a broad base of people that did not want to invest in addictive products that harm not only the addicted person, but the family, maybe community that that addicted person lives within. Um, we found that products that kill people when used as intended were difficult products for the classic responsible investor. So our will not purchase started out being largely a kind of yes no switch. And as time has progressed, newer industries have moved into that yes no switch area without us kind of listing them off in a big, ever growing list of no nos. But we find that industries that make money by keeping people in prison, it's you can't find the positive social impact from doing that, from their existence. So we don't invest in those things. Now, even on the things that we seek, because of this industry specific research, we're not looking at a mining company in the same way that we're looking at a company that manufactures clothing. There are different standards involved in their behavior. Even in those, the best of class is going to be very important to us. There are certain companies that are going to um, do particularly well and recognize all of the threats coming at them and take the steps necessary to convince us that this is a proper way to do it. I think Domini was one of the very last funds to drop McDonald's. I came under a lot of attacks on McDonald's, and I kept saying to the people, the audience, every time I ask them to do something, they do it. I complain about the clamshells, they get rid of the clamshells. I complain about the conditions of the chickens, they get rid of the chickens. I complain about the rainforest sourcing of their beef product, they get rid of the rainforest sourcing of that meat. It was a big problem. But eventually that happy union did fail.
And we
The
do, on those exclusionary standards, really think about those as, those that are fundamentally at odds with those twin goals that we have of universal human dignity and ecological sustainability. We do recognize, um, so the example you were saying, Amy, with for-profit prisons, that is when we're looking at industries where the goal is to provide goods or services as widely as possible and as cheaply as possible, it's pretty hard to fit that into a prison system, which we believe should be a public good. So there are different ways to think about the exclusionary screens when we do still employ some exclusionary screens, but they are they're limited in and they have been long standing for us. So we don't use best in class approach where we're looking for the best tobacco company. We exclude all tobacco. So hopefully that helps satisfy. We're coming down to the last couple of minutes. I'm sorry, I know we have so many questions we didn't get to, but there is one question, Amy, that I'd like to get to you before we wrap up, and really thinking of it as really your closing reflection before we close today. If there's just one thing that you want everybody participating today, and we thank you all, attendance has been fabulous. We really appreciate it. One thing you wanted everybody watching today to do this week, what would it be? I know, putting pressure on, like giving them homework, a to-do list.
Oh, well, remember, we can do this. I mean, we can do this together. It's a planet worth saving. And there are a lot of wonderful things that an individual can do to be part of the solution. But in my own humble opinion, the most straightforward is to become a responsible investor.
Amy, thank you.
Thank you.
Thank you to everybody who joined us today. We really appreciate your time, your questions, your participation in this conversation. We hope you'll join us again June 3rd for National Impact Investing Day each year and every day in between.